Welcome to Portfolio Casts, the podcast where we break down real investor portfolios using publicly available data.
In this episode, we're analyzing Thomas Russo from Gardner Russo and Quinn, based on their latest reported 13F filing, exploring the key holdings, portfolio concentration, and what the positioning might tell us about their thinking.
Most investors run from pain, but Thomas Russo looks for it. He calls it the capacity to suffer, the rare ability of a company to sacrifice today's profits to own the next 50 years. In a market obsessed with the next 10 minutes, Russo is playing a game where the clock barely moves. This $9.4 billion portfolio is a fortress of delayed gratification assets. He is currently trimming high-flying tech and financial anchors to double down on unloved global beverage and luxury franchises.
That's the heart of the capacity to suffer theme, Sarah. To Russo, the ultimate filter isn't a low PE ratio, it's a management team willing to look bad on paper today to fund an insurmountable moat tomorrow. If a company spends a fortune to break into a new market, their short-term earnings take a hit. Most Wall Street analysts scream sell, but Russo sees that suffering as a down payment on a multi-generational compounding machine.
It's a bold strategy, especially when you look at his biggest anchors. Russo holds massive positions in Alphabet and Berkshire Hathaway, totaling nearly a quarter of the entire fund. But here's the tension. He just trimmed Alphabet by 8.6% and Berkshire by 5.1%. It raises the question, is he losing faith in the suffering required for AI dominance, or is something else going on?
I don't think he's exiting. He's rebalancing to maintain his capacity to stay. He's harvesting gains from those tech-heavy winners to fund the areas where the market is currently underestimating brand power. Look at Heineken holding Envy. While he was trimming almost everything else, he increased his position in Heineken by over 10%.
Heineken is such a classic Russo move. It's 6.8% of the portfolio now, worth over $682 million. Let's look at the scorecard for Heineken. Moat, ultra-wide. You can't just recreate a global beer brand overnight. Valuation, fair, with a PE of 19.0. Momentum, decelerating, and risk, concentrated consumer sensitivity. Mike, technically, it's trading right at the top of its 52-week range of $56.40 to $71.40, yet he's buying more. Why?
Because Heineken is willing to suffer through marketing spends and global distribution costs that eat into today's margins. Positioning-wise, it's in a clear uptrend, but Russo is looking at the 3.07% dividend yield and the long-term pricing power. He's comparing that to something like compagnie financière Riquimont. He trimmed Riquimont by about 3.3%, even though it's a powerhouse in luxury.
Riquimont is a $696 million position for him. It's interesting because, like Heineken, it's trading at the very top of its 52-week range around $193. Technically, that's an uptrend, but Russo is slightly pulling back. Is that a comment on the luxury cycle?
It's more about discipline. Riquimont has a PE of 23.1. He's keeping the core 7.4% of his portfolio because it fits the multi-generational theme. These are companies that withstand cycles. We see the same with Nestle. He trimmed it by nearly 4%, but it remains a $549 million anchor. Nestle has an 18.0 PE and a 4.15% dividend yield. Technically, it's also at the high end of its 52-week range, but it represents that capacity to suffer through inflationary periods by passing costs to consumers.
That pricing power is the common thread. It brings us to Philip Morris International. It's one of his largest holdings at 8.1% of the portfolio. He trimmed it by 4.3% recently, but it's still in $836 million bet.
Philip Morris is the ultimate hedge. It has a high PE of 32.4, which may scare off value hunters. But in the 52-week context, it's about 4% below its high of $186.69. The suffering here is the regulatory environment and the massive shift to smoke-free products. Russo is betting that the 3.32% dividend and their ability to raise prices will protect the fund if the market turns risk-off.
So we have this $9.4 billion fortress built on the idea that short-term pain equals long-term gain. But it leaves us with a massive question. Can this philosophy survive a market turn where investors are increasingly impatient for AI returns? And why is he trimming those tech anchors like Alphabet and MasterCard right as the AI race heats up? We've spent years watching Thomas Russo hunt for moats in chocolate and beer, but he's shifted the focus to a new frontier. We're calling it digital pricing power. It's the idea that tech platforms like Alphabet and MasterCard are the modern version of the 100-year-old beverage brand. They control the infrastructure of how we spend and what we see.
It's a fascinating transition. Russo is applying that same global franchise logic to Alphabet. If you look at the portfolio, Alphabet Inc. is a massive 12.1% anchor worth over $1.5 billion. Even with an 8.65% trim recently, the thesis remains, as long as the core business stays durable, it's the ultimate digital toll booth. On our scorecard for this theme, moat, ultra-wide, valuation, premium spare, momentum, decelerating, and risk, concentrated consumer sensitivity.
But that decelerating momentum is the elephant in the room. Russo trimmed Alphabet, and he also reduced MasterCard by nearly 4%. Is he signaling that the capacity to suffer for these tech giants is being tested by the AI race?
Potentially. Technically, Alphabet is in a clear uptrend, sitting about 1.1% below its 52-week high, but the 32.8 PE ratio shows you're paying for that quality. MasterCard is a different story. It's more range-bound, sitting right in the middle of its 52-week context. Russo's trimming here feels less like losing faith and more like disciplined rebalancing. He's taking some off the table while these digital anchors are still near the top of their game.
It's the same story with the harvesting phase for companies like Uber and Netflix. For years, these were the poster children for suffering burning cash to own the market. Now, Russo is trimming them 5.15% off Netflix and 3.8% off Uber. Are we finally seeing these stories mature into the capacity to harvest profits?
The data suggests a pivot. Netflix Inc. is technically in a downtrend, currently positioned at just 3% through its 52-week range. It's a $429 million position, but the bloom is off the rose momentum-wise. Uber is also range-bound, about 21.5% below its recent highs. Russo seems to be saying that while the business moats are there, the valuation, especially with Uber's PE at 10 and Netflix at 32, needs to align with the reality of a more cautious consumer.
Which brings us to the ultimate anchor, Berkshire Hathaway. Despite a 5.11% trim, Russo still holds over $1.1 billion in those A shares. That's a 12.5% allocation. When you combine that with his other holdings, he has an 18% bet on Buffett's ecosystem. Why keep such a massive anchor if you're worried about a risk-off turn?
Because Berkshire is the ultimate capacity to suffer vehicle. It's built to weather the exact storms Russo is bracing for. Technically, Berkshire.A shares are range-bound about 11% off their highs with a very reasonable PE of 15.4. It's the fortress. When Russo reduces positions in 10 of his top 12 holdings simultaneously, including Alphabet, MasterCard, and Berkshire, he's not running for the exits. He's building a cash buffer.
It's a risk-off turn, but with a Russo twist. He's shifting from the digital moats back to the physical ones. While he trimmed the tech giants, he actually increased his stake in Heineken by 10%. It suggests he believes the suffering in the global beverage sector has gone on long enough, and the rebound is where the next 50 years of compounding will happen.
Exactly. Whether it's a $538 share of MasterCard or a $722,500 share of Berkshire, the philosophy is identical. He wants businesses that can survive being unloved. In a market that's obsessed with the next 10 minutes of AI news, Russo is looking at his $9.4 billion portfolio and deciding that patience isn't just a virtue, it's the only competitive advantage left.
The capacity to suffer isn't just for the companies. It's for the investor, too. Russo is willing to watch his tech anchors decelerate if it means he's positioned for the multi-generational rebound in global brands. For Thomas Russo, the clock isn't ticking, it's compounding. That's the episode. We'll see you next time. Thanks for listening to Portfolio Casts.
This content is for educational purposes only and should not be considered financial or investment advice.
Any figures, prices, or portfolio values discussed are approximate, based on public filings and used for illustrative purposes only.
The views expressed are interpretations of public information and may not reflect the investor's current positions.
Follow Portfolio Casts for more investor portfolio breakdowns.